Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate with your host, Kevin Perenio. As an owner and C-level executive for 20 plus years in finance, KP is here to serve you with all of his knowledge and experience. Whether you're a broker, realtor, or just interested in the economy, this is the podcast for you. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Corona, California. Another late night here. It's awful. You'll see what time I posted it, but I'm trying to stay caught up. Look out for Capacity in conjunction with the Mortgage Bankers Association holding a seminar in about 8 hours. So the great Marina Walsh from the MBA will be there with some awesome charts. I got a chance to take a look at them a couple hours ago, and some other great executives will be there. Of course, the team from Capacity, and we are a big proponent of it. Just personally signed and renewed the contract myself. So look at that, 10 a.m. Pacific time. Okay, we're going to talk about some R words, but not the recession one that everyone keeps talking about. Maybe we'll talk about that, but I got four more. I got Russell reconstitution. I got ARPU, which is like a technical term, revenue per unit. And we're going to talk about Russia. That's just Russia once, but I said it 3 times for dramatic effect. But you know what no one's talking about? The FHFA made this 50 basis point fee, if you will, inside universal mortgage-backed securities and has threatened the fungibility of the universal mortgage-backed security. So just a recap. Not too long ago, we used to have different kinds of coupons depending on which GSE was buying the loan. So you had either Fannie coupons or Freddie coupons. You still have Ginnie coupons. So just remember, I say this thing about the secondary market. It is cold, heartless, and unforgiving. And we now have this cold, heartless, unforgiving 50 basis point fee that is inside securities now, placed on loans when either Fannie or Freddie securities are bundled together in the same security. So let's just say that the majority of a universal mortgage-backed security loan has Fannie Mae loans in it, loans you run desktop underwriter on, and less of the loans in that overall security have some Freddie Mac loans. Well, the Freddie Mac loans, because they are not the super in there, the Freddie Mac loans get taxed 50 basis points. I don't know, so I'm trying to understand. I'm still reading up on it, but that was announced and will go into effect, for all new securities as of July 1st. So what's interesting is when you talk about the word universal, the point is this whole industry shifted away from, all right, if I'm doing Fannie loans, I'm, selling to open a position with my broker dealer for Fannie Mae coupons or Freddie Mac coupons. But now you don't have to mess with all that. Now there's one big fungible security. It's all universal. It's all GSEs. They're all GSE backed with, the full faith and credit of the U.S. government. Obviously, Fannie and Freddie are still in conservatorship. So we're going to have this universal mortgage-backed security. And literally, there were like years of comment periods and work and deadlines to finally get to this point. And now after the fact, 50 basis points on the junior securities in a commingled security of universal mortgage-backed security. So more info on that. I just find it odd. I guess let's just not use the word fungibility anymore, which my great partner here, Gary Malice, our chief capital markets and strategy officer, loves to use the word fungibility. It does help with flow and, getting, when things are fungible, it means they're the same, like a universal mortgage-backed security. So we're going to see whether the word universal is going to be removed from the secondary market, or maybe just the fee. I don't know. We'll keep you up to date on that one. So that one's out of there. Next storyline. Let's talk about the jobless claims last week, 229,000. How can we be in a recession when we still have such healthy job market? It makes you wonder. There's still 11 million jobs that are open. The unemployment rate's still under 4%. We haven't seen a lot of job loss. We're hearing anecdotally, obviously within our industry, our industry is kind of a leading industry, a leading indicator of the economy and all things that are going on. And we're starting to hear some of the larger firms out there in the tech spaces and whatnot. Obviously, fintech within our industry, we saw Better.com or Better Mortgage, fire people on Zoom and all the craziness. And a lot of the heavy refi shops, they've kind of gone through what they're going to go through. And the slides tomorrow that Marina is going to show is going to kind of accentuate how the cost per loan is creeping up. Part of that is because a lot of independent mortgage bankers, such as us, have not been laying off. We have been holding on to our staff. But overall, throughout the industry, that is leading to obviously higher costs. And so, I think independent mortgage bankers are in a really good position to hold their ground. And you see a lot of these large banks and hedge fund backed companies in our industry and tech giants and Wall Street backed firms, they have this playbook where they want to cut costs, and that's usually where they go. We like our teammates. So we'll be interesting to see how that continues to play out and feed into the narrative that we are either already in a recession, whether technically by the definition of 2 GDP negative quarters in a row. We're about to get a revision for Q1, which we already know was a negative quarters later this week. So could be some data points there on whether that actually was negative. Did it get revised up? We've seen so many crazy data points get revised up. Speaking of, May pending sales came out, and there was a consensus for a decline of 4% in the month of May. There was an increase in pending sales of 0.7%. That 0.7%. Pending sales are deals under contract that have not yet sold. And so in the month of May, it was a strong month. We had our best May ever as a company, May 22 versus May 21 or 20 even, because it's the middle of spring purchase season. Purchase money contracts start to really come into place after people get out from New Year's Eve. They start hunting for homes. They get under contract, late January, February. It gets warm in some areas, so even more people are out looking for houses. And those contracts tend to snowball in the spring purchase season, March, April, May, and June. Those are your big peak months. Even July for some of the colder areas in our country, they kind of start later, so they end later. But things do typically kind of slow down in the summer. People taking vacations. July is typically a slow, sluggish month. But one of my theories, obviously, is that not only is May in the middle of spring purchase season, but with rates gone up as much as they had, people are starting to say, hey, it's now or never. This is my last good chance to make good on the rate that I locked that no longer exists because rates went up. Plus, sellers who are kind of sitting around waiting for the peak, they tend to have gotten off the fence. And so some of the data bears that out. Pending sales went up in May. Big surprise data to the upside. The overall trend year over year is still down. I believe it's just under 13% down on pending sales. So new home sales came out last Friday, 11% from April to May. Huge jump, far above the consensus of 590,000 and the 690,000 annual rate. So pretty interesting to see that surprise to the upside last week. I saw a really cool stat that Barry Habib and team put out when they broke down sales, existing versus new home sales. Existing home sales constitute about 90% of all home sales. New home sales, which is interesting the way the math is said, like, we have a 7.7 month supply of new homes being sold. Well, that's because a lot of them are still being built, right? They're not built yet. And I mentioned last week on my video that Logan Motoshami mentioned that once a new home is built and finalized, it's off the shelf in less than a month. And Barry and his team pointed that out again last week as well. Great information from MBS Highway and Logan Motoshami, lead housing analyst for Housing Wire. 88% of all homes sold within 30 days. Pretty crazy. So let's talk about the stock market. It's had a little rebound here, but it's still also in a downtrend. And, there's a saying called the Russell reconstitution that happens the fourth Friday of June. The Russell Index, the Russell 1000 and 2000 are basically small businesses around America, the engines of growth. Some fall out of that top 1,000, 2,000. They and then new ones emerge as businesses grow. And there are ETFs out there that have to buy these companies, and so it's forced buying into these companies. There's also a growth versus a value Russell index. Companies like Meta, Facebook, Netflix, PayPal, and Zoom, they were growth stocks because they're adding users and adding users and adding users. Well, now they're value stocks because they're not adding as many users, but now the metric to look at them is revenue per user, ARPU. And Russia defaulted on their debt. Suckers. Hey, it's KP coming to you live from Corona, California. Well, we are finishing up the month, the quarter, and we're headed into July 4th weekend. I know we all are serving our communities and putting people in houses so they can celebrate in their brand new home, because it's mostly purchase business nowadays. And they're going to have a barbecue in a house that you helped put them in. And you should be very, very thankful and humbled that you were part of that process. Literally the American dream. And for me, as a bicentennial baby, which means I was born in 1976, I just add 200 plus my age as of August. We're 246 years celebrating this great nation, the absolute best nation by far on earth, a relatively young one as well. So have a great, safe, happy July 4th weekend. I hope you're excited about it. Remember, it is very much a home ownership holiday. We're putting people in houses to celebrate, popping off fireworks and all that good stuff. Okay, so we're going to talk about diapers, diamonds, and divorce. I'm sure you've heard that. Or debt. You've heard the 3Ds, the 4Ds. Well, your boy here, who's a big fan of hip hop, likes to make up his own rhymes, and people like to bite off of it. And I'm totally cool with that. We're building a community here. And I'm going to tell you about the 7Ds. You've never heard the 7Ds, and it's a specific order. So feel free to steal it, use it, put it in your marketing. I know some of the things that I've said in the past, like path to pivot or pivot to purchase or deeply rooted in our communities. Some great marketing teams out there have bitten my rhymes, and you know who you are. And that's okay if you don't give me credit. I feel humbled and even slightly flattered, even though that's kind of egotistical. But I do love the fact that we're building a community here, and I'm going to talk about the 7Ds here shortly. But before that, let's talk about FGMC, First Guarantee Mortgage Corporation. Now, I'm not talking about it in a salacious way or a tabloid way. I mean, all the news rags talk about that kind of stuff. I actually have some really fantastic colleagues that I know there. Obviously, it's awful that here's our industry that led this nation out of the pandemic and the recession. And typically, housing is one of those leading indicators heading back into a recession. So you start to see job losses, and you start to see consolidation, and companies go public, or some companies acquire others. And what's interesting here is, there's some great people that work at this company, fantastic company. We've actually been able to help and hire like account executive. We're working on some developers in our IT team. And I love here on LinkedIn that the community that we've created rallied around, and I'm seeing some boards, some posts being made, trying to help people find a job and do some good placement. Gotta love that about this people business that we're in. So the reason I want to talk about this is because I'm getting questions, and people are asking me like, well, what's next? Or where does it end? Or is there cracks in the credit market? Is this 2008 all over again, or 7? Is there going to be an implodometer? And people put it out there and find out what's going on. I want to explain a little bit of what happened and try and put it in some context in a way that I've said before on these videos, but I don't really hear much about. The biggest reason why there are issues in this specific case is because of the non-QM market. And some of you are maybe unfamiliar with the roots of that. Before the Dodd-Frank Act and prior to the Great Recession of 2008, we had what was called subprime loans. And pretty much we would say, hey, if the FICO score, your credit score is under 620, it's a subprime loan. It's not A paper credit, it's subprime. And then that kind of morphed into, well, there's Alt-A, alternative A credit, right? So maybe there's an 80-20 LTV no doc where literally the income blank, assets blank, job blank. It's just run your credit. Is it 620? Great. Here's $417,000. Oh, you have a 619 credit score? Sorry, that's subprime. I can't give you an application of $417,000 with a blank job, blank income, and blank assets. That literally was alternative A. It all ended up being subprime. So to get past all that, and which, by the way, those loans were bundled into a lot of mortgage-backed securities that also commingled with a paper. Fannie Mae loans, Freddie Mac loans, even Ginnie Mae loans. And it just cratered the system, which can be fragile when you're talking about leverage credit, CDOs, credit swaps, collateralized debt obligations, all the acronyms out there, right? So Dodd-Frank Act worked 2 years ago during the pandemic, and it's working again right now. Let me say that again. It is working. Regulation is working to save the integrity of the entire system. During the Dodd-Frank Act, there was a designation of what's called a qualified mortgage versus a non-qualified mortgage, non-QM. A non-qualified mortgage is basically a mortgage that doesn't have safe harbor, if you will. It's like a legal term, but a rebuttable presumption. But those loans are kind of what used to be called subprime. So that means that your Fannie Mae and your Freddie Mac loans, your conforming loans to the GSEs, which are now have a universal mortgage-backed security, which I talked about on my last video, in Ginnie Mae, which is typically your government loans, your FHA, VA, USDA, rural housing. Those securities, which we buy and sell money, are not commingled together with what used to be subprime loans, which are now called non-QM loans. So some of those non-QM loans have been really disrupted lately. And with the huge headwinds we've seen with interest rates rising quite a bit very rapidly, some of the buyers of non-QM loans, which are all private, private companies, for example, PIMCO, fantastically run company founded by Muhammad Arian and Bill Gross, who live in Orange County, which I moved to 6 years ago. Brilliant minds, those two. I have a lot of respect for them. Well, the legacy of their company, which they're no longer at, has an investment fund that invested in First Guarantee Mortgage Corporation. Now, the irony here is there's a lot of regulation you hear from DC about us independent mortgage bankers and how we don't have enough money, we don't have enough capital, and we're going to disrupt the system. And the next time there's a 2008, which there can't possibly be a 2008 because of this regulation, Dodd-Frank, which is working because it stripped out all the subprime loans and it's not cratering the Fannie and Freddie portfolios, which I digress. But you've got this fund of a giant investment firm in PIMCO that they decided to pull their financing out behind this company, and FGMC was trying to find some new capital, and they weren't able to. So that highly regulated and very well funded and very well backed company, PIMCO, they would have passed all the regulation that's being proposed, which supposedly IMBs would not. But because they are under the radar because they're so well capitalized, but them pulling out still has the net effect that all the regulators are trying to get to prevent from happening. It is cratering this company, and it's sad because our colleagues are losing jobs. These non-QM loans are not in the mortgage-backed securities right now, so are not disrupting Fannie, Freddie, and the FHFA and all the things that they regulate in those funds, which right now, Fannie and Freddie, the GSEs, are under conservatorship. So my point is Dodd-Frank is working. The regulation is working by stripping out and making private companies back and fund and trade non-QM loans. So there is some disruption, but that disruption did not reverberate into a broader credit collapse like it did in 2008. So it's sad that it's isolated to this company, but the integrity of the system, because of Dodd-Frank, is still intact. So we're going to live to fight another day as a whole, and unfortunately, we're going to help our colleagues and try and lift them up and place them. So anyway, just thought I'd throw it out there. It's a perspective that no one's talking about. I've said it multiple times every time we have this disruption in the non-QM market, and this will not be the last disruption. The 7 Ds, what are they? I put them in this very order. Deployment. Let's talk about our veterans and our service members first. Deployment. They get a VA loan. They should be treated first with respect because they put everything on the line. Deployment is the first of the 7 Ds. Then we've got diamonds because then you may get married. So you have some household formation. Maybe let's get out of our apartments and let's buy a house together. Or Diapers. You got kids. Maybe you got more kids. So now your house getting bigger. You need more space. You got debt because of the kids, right? So maybe you do a cash out or a refinance. You get divorced, right? You got to split. Someone keeps a house. Maybe you sell it and you both buy two houses or one. Probably more debt. You probably add more debt after that, but we're only going to say debt once. And then, of course, you have downsizing, which you've got the elderly that maybe empty nesters. Let's buy something smaller. And then you have death. You know what? Got to sell that asset. Don't forget the HECM loan is in there somewhere. The 7Ds, you heard it here first. Let's use it. Have a fantastic and safe July 4th weekend. Thank you for allowing us and me to serve you.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.